Okay, good morning, everybody. Thank you very much indeed for joining us for the latest in our series of Pulse webinars. I'm Darren Moth. I'm one of the international sales managers here at Novia Global. So thank you, first of all, for joining us, as I say, wherever you're dialing in from. Pleased to say I think the UK is bathed in glorious sunshine today. So let's put us all in a slightly better mood, those that are UK based. It's a pleasure this morning to be joined by Nathan from Marlborough. I've had I want to say pleasure, but in some ways the misfortune of presenting at an event with Nathan before. He's a really sort of engaging, enthusiastic and informative presenter. And I think he went up before me, and then I had to go on afterwards and talk about some legislative changes with pensions. So I think I
Sorry
stole
about
the show that day. So yeah, not born a grudge, Nathan. So without further ado, really, as always, you know the drill. If you've joined us on these before, if you've got any questions, please do drop them in the Q&A box. But I'll pass you over to Nathan now for I'm sure will be another one of those very engaging presentations that I mentioned there.
Perfect. Thank you, Darren, and really welcome to everybody on the call today. So, as always, what I really want to do today is give you a couple of key takeaways about what's happening in markets and some of those nuggets which may be helpful in client conversations. So normally what I do is I put pen to paper and I try to think about the key things that advisors may be coming up against when they have those client meetings. So clearly the biggest topic is tariffs. So what I really want to do when it comes to talking about tariffs is try to understand Donald Trump's perspective. So I want to put myself in his shoes to think, how is he thinking? Because fundamentally, I believe that'll help us to make better decisions and understand exactly what's happening. The second thing I'm going to talk about is the US economy, because a lot of questions about the strength of the US economy, whether this is the end of the US, and really talk about, Donald Trump walking that tightrope between the policies which he wants to enact and obviously keeping the US strong on the other side of that. And is there a safety net if he gets that wrong? And then what does that all that mean? Because clearly it's been an extremely volatile start to the year. We've had some very outsized moves in equity markets in April. So big down days, but also big up days. So what should we be expecting going forward? And I think that too is clearly important. So let's start with tariffs. So this is a grand master plan which has been over 30 years in the making. So Donald Trump has been talking about tariffs for a very long time. So he wrote the book, The Art of the Deal, which was released back in 1987. And there's video clips of Donald Trump talking about trade and trade practices literally 3 decades ago. So it's something that he feels quite passionate about. So again, putting yourself into his shoes, this is something which he believes in. And to give you some context, I've got two small kids, and I was away recently on a business trip, and I came back with some presents. One was pink, one was blue. And what I had then was the problem I created was a situation which was unfair because the kids were fighting over the different toys and the different colors, and that's not fair, Daddy. And Donald Trump really thinks that tariffs aren't fair, the way in which they are implemented today. So this is the big sheet which he unveiled, which really spooked the market because nobody was anticipating the level of tariffs which the Trump administration were thinking of. And ultimately he's calling them reciprocal tariffs. You've got tariffs on us, therefore we're putting tariffs on you. Now, people will argue saying maybe those numbers aren't exact, but it's more about the direction. What is he trying to achieve? So fundamentally, he is a businessman and he wants to negotiate. That's something which he is really passionate about. He's passionate about business. He's passionate about negotiating deals, and he's passionate about making sure that they're fair. So, putting yourself into his shoes, how is he thinking? So what does that mean? So when it comes to tariffs, we've had these big numbers. So China has got tariffs on US goods. And then the US is saying, you've got 67% on us. We're putting 34% on you. So By doing that and doing that with all countries, what he's doing is he's forcing those countries to come to the negotiation table. Plus, he's putting leverage into that negotiation. So he's now holding the upper hand because what he's saying here is that we're only going half to the level that you have on us. And therefore, if you don't negotiate, we'll go to 100% of that level. And that's now forcing countries to come to the negotiation table. If they did nothing, if they just said, hey, look, we need to strike a deal on trade, but didn't change the agreement that's in place already, nobody would come and negotiate. So this is forcing people. And that's just the way that he operates because he is a businessman and he's used to negotiating deals and he's used to negotiating hard. So hopefully that gives you a bit of context. Now, the pushback here is that you have a book written by Adam Smith, and it's back in 1776. It's called The Wealth of Nations. And in that book, fundamentally, they describe the fact that it makes sense for the country who's most efficient at producing something to produce it, and that will create better trade for everybody. So if you're good at making cars, you make the cars. If we're good at making computers, we'll make the computers, and we'll trade, and it'll be great for everybody. But if you read that book and you go into the detail of it, it will suggest some scenarios where that relationship may not work. So everybody's thinking, oh, we should just have free trade. Now, China joined the World Trade Organization back in 2001. And the thinking there was that, look, this will be great for corporate America because if we can get into the Chinese market, they've got 1.6 billion consumers and our companies will benefit. So let's bring China into the World Trade Organization and let's all benefit from trading together. But it didn't play out exactly as people thought. You had all of these US companies going to China to make it. They've got great businesses, great franchise, great products, doing really well in the US and Europe, and they go to China and it just doesn't happen. Why is that? Fundamentally, a lot of these companies, their products were replicated. So it's interesting if you look at, say, Starbucks or Tesla as an example. So Starbucks opened all of these coffee shops, and then suddenly this other coffee shop in China explodes called Lupin Coffee. The franchise looks very, very similar to Starbucks. The coffee even tastes almost the same. And this is a common strategy in China where what they'll do is they'll replicate the technology and do it themselves. So you found that company after company after company has pulled out of the Chinese market because they just didn't make it. So from a trade perspective, it never really worked out in the US's interest or anybody else's interest for that matter on the scale that they expected. And Tesla is another great example. One of the best companies in the world, pioneering the space in electric vehicles. And then suddenly they're unseated by another company, BYD, Build Your Dreams, Chinese EV manufacturer. Those Teslas and BYD cars look very similar, funnily enough. And this is the problem. So in that book, The Wealth of Nations, they just talked about the fact that if somebody is implementing practices which undermine this free trade, then the whole system doesn't work. So if you are supporting specific industries by state backing them, ultimately, if it's an unprofitable industry, let's think of solar panels, wind farm manufacturers, let's think of steel manufacturing. So China's got all these industries, but a lot of them are supported by the state. And so some of them are unprofitable. But if they're being funded by the state, it just means that they're able to undercut everybody else and dump their steel in the UK or Europe and put their steel manufacturers out of business. Then they can raise their price, and etc. So when you have those unfair practices, it undermines this whole argument about trading freely. And that's not fair. So you can see where Donald Trump is coming from. But the way in which he's gone about it is unsettling. So if you go out and you just put these large blanket numbers on everybody, you can see there's going to be reaction in markets. But fundamentally, you have to put yourself in his shoes and he's just thinking, I just need to get these people to the table to negotiate and get better terms. Because my other analogy is that when my father-in-law is around, he'll often get dinner. in some sense, he's almost expected to get dinner. Should he be? So he's now retired. Should he be paying or footing the bill for everybody? And that's how the US is thinking about things. We're kind of footing the bill for a lot of stuff. We're helping to support the Chinese economy. We're helping to support their industry and obviously the populace, and they're all benefiting from all the stuff we're buying. Now, you could also say that, certain industries are benefiting from that too, and certain institutions were benefiting from that too. So the defense industry would be a good example where the US has been supporting NATO and almost buying their dinner, paying for their dinner. But they're saying, should we be doing that? If you have a war between Russia and Ukraine, is that not Europe's problem? It's on their doorstep. Should they not be funding that? So the outcome of this is that you'll obviously get more spending on defense. And the other thing which it's highlighting is supply chains, and I'll talk about that in a second. But hopefully that just gives you a little bit of insight into how Trump thinks. But the outcome of that is that ultimately tariffs are now moving from this low level to this really high level. Now, I do think that the peak bad news is behind us, because when you implement tariffs on everybody, if you're then negotiating tariffs at a single country level, even if the outcome is bad, it's not as bad as tariffs on everybody. So what we expect to happen is that countries will begin to negotiate with the US. Some countries will strike no deal, perhaps China. Some countries will strike deals, which are fair, and some will be in the favor of the US. There'll be all of these different variances. And some companies will do the same. They'll think about, whether there's tariffs being lobbied on the goods that they're bringing into the US. So auto manufacturers will be a good example. Some companies will increase the price of their cars. Some people won't. They'll all take a different approach. So fundamentally, the number which we see here, this expected tariff level, I expect that to come down. And I believe we're past peak noise when it comes to tariffs. And ultimately, this will pass. All of these events in markets constantly happen, whether it's tariff, whether it's COVID, etc. And we get through this. So we do think we're at kind of peak noise when it comes to tariffs. So the key question is, what is the US trying to achieve here? And fundamentally, they say our economy is here and we want to get to here. How are we going to do that? How are we going to achieve that? Well, firstly, what we want to do is we want to, make a bigger manufacturing sector, i.e. tariffs, bringing back jobs to America. Fundamentally, I don't think this is going to be a massive driver. You will see some industries bringing back jobs, but if you bring back a car manufacturing facility that's in Mexico to the US, is that going to change the dial? Because fundamentally, if you look at those car manufacturing facilities today, they are largely automated. So there aren't that many people actually hired within that space compared to a factory line building cars 60, 70 years ago in the Rust Belt. But what it does do is it does help with the voter base. So voters, this is a voter-friendly policy. But marginally it'll help, but it's not going to be the big game changer. So for us, I think one of the key things will be the fact that they're looking to reduce government spending. So this DOGE, Department of Government Efficiency, which is headed up by Elon Musk. And the big pushback there is more about the approach that they're taking. So Elon Musk, richest person in the world, great track record of running incredible companies. But fundamentally, his approach with, look at any of the companies he's run. When he goes into a company, Twitter, it would be a great example. His way of dealing with things is actually, let's just turn off all of the spending. Let's turn off this, turn off this, turn off this. And if something breaks, we'll switch it back on. So if it's not working, we'll just switch it back on. Now, that's okay if you've kind of isolated within a company, and it's probably still, it is still quite disruptive and a radical way of doing things. But when you try to do that at a country level, it's a whole new ballgame. But that's what they're looking to achieve. And the reason behind that is because government debt in the US is extraordinarily high. And the government's view is that, look, that's not sustainable. We can't keep paying these high interest payments on this debt and keep growing the debt. We need to think about spending the money more efficiently. And if we can do that and get more bang for our buck with the money we're spending, it's going to create higher economic growth. And the view is that there's just so much wasteful spending with all of the government money that's been allocated X, Y, Z and inefficiently, that they'll be able to spend less and drive higher growth because the money will be spent more wisely. And I can give you umpteen examples. And obviously, if you look on the Doge website, you can go into the website and you can find all the instances where they found areas where there's a misallocation of money. So under the Biden administration, there was a policy to bring broadband to the rural community, and 50 billion was allocated to this. Look, we want to bring broadband to rural communities to help them thrive. Because of regulation, these rural communities got zero broadband. Actually, you can't build that here and here, because fundamentally there's this law here that says you can't build that factory here, and there's this other law and you have to fill out this form and that form, etc. So because of that, that's one of the inefficiencies the government sees. We've got all of this bureaucracy, all of this red tape. It's slowing down business, it's increasing cost, therefore it's creating inefficiency. And with that specific broadband money, that 50 billion, not a sod was turned. Where's the money gone? And fundamentally, on the other side of that, you've Elon Musk, who's got a company called Starlink, which can turn on broadband internet from the sky to any home, anywhere, in the fraction of a second for a fraction of the cost. So you can see why a lot of the individuals who've come into the administration, many of them from a tech background, are just saying, look, this thing is just run. This country is not being run efficiently. Now, I think from a market perspective, when you try to change everything everywhere all at once, that then creates that uncertainty. So what markets love is certainty. They want to know what that tariff rate is. And today we don't, because it's up and down, it's on, it's off. But we will get past this and those deals will be negotiated, and then you will get that clarity. And then people will start to see actually some of these government initiatives are reducing spend. And therefore we can get the interest payments on our debt down, and that steadies the bond market. And that's already starting to come to fruition. So, quite a lot happening, but they do have a plan. Now, what we've seen is a lot of uncertainty in markets. So we've seen the equity market sell off quite a bit. We've seen the dollar sell off. People are worried about, is this the demise of the US? Is the end of US exceptionalism? But fundamentally, there is method to the madness. Now, if the dollar weakens, it makes your manufacturing goods more attractive to overseas buyers because it's cheaper. Now, what tends to happen with the US dollar is they call it the dollar smile. So when the economy is good, everybody wants to invest in the US. So they're buying more dollars to buy more US assets. And when it's in demand, it's strong. And on the other side of that, when you have a recession, everybody wants to shelter in the dollar because it's the reserve currency of choice and it's more stable. So it does strong in that environment too. So they call it this dollar smile. Now, what's happened recently is people are concerned about this reserve currency. Is it the reserve currency of choice? And therefore, it's weakening. Do we want to hold the dollar? People are selling US equities, selling their dollar to buy European equities, Asian equities, UK equities. They're diversifying because they're uncertain about what's happening in the US. And that's weakening the dollar. So do we think that this is the demise? No, we don't. So fundamentally, what this is the US is trying to get its house in order. They're saying, look, we've let things go too long. We've let this free trade, which isn't necessarily free trade, go on too long. We've been supporting these wars and paying the bill for too long. We need to sort that out. We need to spend the money more efficiently within our own government. And I think once you get past this pocket of uncertainty, you start to see a stabilization. So there has been this kind of rush to gold as well. But fundamentally, the companies in the US are still amazing companies. And you still have, the US as that strong economy, research and development. So we don't fundamentally believe that's changed. But I think structurally long term, you have the US over here and you have China over here, and China's getting bigger and stronger. And fundamentally, they'll start trading with other people outside of the US. And the interesting snippet is that even with all of these tariffs in place, in 2018, you had tariffs and China's trade went up, not down as a result, because they traded with other people. So they'll continue to look to do that. So that will continue to be a strong economy. And we move to this kind of polarized world where some countries will side over here and some countries will side over here. But fundamentally, there's space. It doesn't have to be about just one strong economy, and it creates a bit of competition, which isn't necessarily a bad thing. The other key concern, I suppose, for markets is around company earnings. What will this mean for company earnings? And funnily enough, company earnings are really, really strong. So profit margin, so the margin that companies are making is high. Why is that? Because you've got low costs, you've got increased productivity. So artificial intelligence is helping companies produce stuff more efficiently, particularly tech companies. So they're able to take out some of the cost in their business. And Google reported its earnings last week. And what they showed was they're generating more and more money through advertising. So people clicking more on their stuff. Why is that? Because the AI or the computer is, helping people find the stuff that they need, and they're clicking on stuff more and saying, okay, look, this search is exactly what I'm looking for. So the advertising is getting more, I suppose, bespoke to the individual because it knows your preferences, and therefore they're seeing increased demand. So that's just one example of how AI is starting to filter through. Despite all of the concerns and what's happening in markets, companies are still delivering good earnings. And so that's one thing we'll be keeping an eye on. But I suppose that, in terms of this safety net for the economy, so we've got Donald Trump walking this tightrope. So on the one hand, he's got his tariffs over here that he wants to implement, and that's tipping him over this side. And on the other hand, he's got the stock market. And if the stock market's falling, is he keeping the economy on track? And this slide here is interesting because what it shows you is it shows you what's important to voters in the US. And what's really important to voters in the US is the US economy. Because if the economy is strong, it means that their portfolios and their pensions are doing well, and that's linked to their wealth. So the number of people in the US who invest in the stock market is extremely high compared to any other country. So 75% of people are in the stock market. So it's a huge number compared to, call it, 20% in the UK or Europe, much lower levels. So I think from a voter perspective, that's something which he has to keep a keen eye on. And what happened was obviously equity markets sold off, and he wasn't too bothered about it because he felt, look, the stuff that we're trying to achieve, once we get through these negotiations, we can do the voter-friendly stuff, the tax cuts, the deregulation, which will drive the market higher. I want to tackle the tariffs now because it's the unpopular stuff, and we got to do that at the start of this presidential term. In 2016, they did it the other way around. All the tax cut stuff, market roofed it, then they started to tackle tariffs. That was unpopular, market came off. So let's do it the other way around. So we do think that once we get past this, you're going to get these pro-friendly initiatives being put in place. So I think that is important to highlight. But what happened was you had this thing called the basis trade. What's the basis trade? So the basis trade is when you buy a US Treasury and then you short a synthetic, so something that's replicating the US Treasury. And there's a small price difference between the two, and you're taking that small fractional price difference. And because it's only a small price difference, what you're doing is you're leveraging that position up so that you're getting more from that return. But when the US put tariffs on China, China responded. They sold lots of US treasuries, and that caused the US treasury market to sell off. So if you're making just fractional difference and suddenly this thing drops down here, you've lost money. Even though it's only a small bit of money, the thing is that was leveraged. So you've lost a lot of money quite quickly. So you're closing out that position really fast, and that's creating a liquidity event in the bond market. Jamie Dimon is on the phone to Donald Trump saying, have you seen what's happening in the bond market? So we need to fix this quickly because ultimately this could create a liquidity event in markets. And then out comes the Trump administration to say, actually, we're doing a reprieve on tariffs for 90 days on all countries except China, because fundamentally it's all about China and China's trading practices. And that, to me, is this safety net. So we talk about Donald Trump walking the tightrope. Tariffs, I'm pretty passionate about that, negotiating all these trade deals, but clearly I need to keep the economy going. And so if he falls, the safety net is actually, look, the stock market is bigger than everybody, and particularly Donald Trump. And he has shown that. So he flinched in the face of this liquidity event. And so for us, that's quite an important thing to highlight, because it means that, they want to push their agenda, but they're not going to push it too hard if it means unsettling the whole thing, bringing down the show. So I do think that's it's quite an important point. Okay, so what does all of that mean? So fundamentally, we are in a volatile year, and this just shows you the performance in different calendar years, and you can see that performance tends to be in that -2%, +2% range the majority of the time. And you do get years where you get these outsized returns where we're kind of outside of those ranges. That's abnormal. There's something happening, some big event, COVID 2020. So there's a big event and it's creating these big volatile moves. And if we look at what's happening today, we've got 4th of April markets down 6%, 3rd of April markets down 4.8%, 9th of April markets up 9.5%. This was that whole rolling back those tariffs and the market actually reading between the lines going, hey, we've got a safety net, and up 9.5%. Now, a couple of key lessons here. Clearly, this is a real live example. We talk about timing the market all the time, and we try to reassure clients about what's happening in markets, give them the information so that they don't make rash decisions. However, some clients won't pay heed to that and will have seen everything that's happening in markets and decided, actually, this is not for me. There's too much volatility. But basically, risk is the price you pay for return. So that volatility is the price you pay for return. But we did look at data, and we went back a very long time, back to the 1950s, and looked at instances where the market have sold off by 5% or more. And within a high percentage of those cases, within 2 weeks, you see big up days. And in this case, it was within a week, you see that big up day. So the big up days do tend to follow the big down days. So it's often when this stuff is happening, that's the time definitely not to react. And you should be considering, actually, is this the time to be adding to the portfolio? Do I have cash? Because that's how you compound at higher rates, compounding over time, and then using market dislocations as an opportunity to get more assets to compound at a higher rate. So this is just, it's really great to highlight this today because it's such a live example. And I think that that's important, particularly to help clients understand the importance of compounding over time. What are the positives? To me, all of this uncertainty, what it does is actually increases the likelihood of interest rate cuts coming through at a faster pace. So in a sense, there is almost method to the madness. If I can create some uncertainty, it causes companies to retrench. Do I spend that money now? Do I move that factory from Mexico to the US? I don't know what the tariffs are. I'll have to wait and see. I hold back on my spending. Consumers as well thinking, okay, well, I don't know if these tariffs are going to be inflationary. Do I hold back? What do I do? So you create this pocket of uncertainty. And fundamentally, that takes the heat out of the economy because the US economy had been running quite hot. And that's good from a central bank perspective, because if you can get that heat out of the economy, it means that the likelihood of interest rate cuts coming through quicker is higher. That's good for bonds, really good for bonds. It's also good for equities, and it's also good for consumers. So you're reducing the cost of those mortgages, reducing the cost of those auto loans and stuff you want to buy and take loans out for. For companies, it's the financing costs for growth, they come down. And then you can see the snowball effect from having rates coming through at a quicker pace. We do think that that's a positive, and possibly people not talking enough about that. And then lastly, I'm just going to finish up on this slide. And so it's just a reminder that we do have bear markets. Bear markets are falls of 20% or more. Now, the US market, was down, call it just over, say, 10% at one point. We're now down about 5% year to date. So not near bear market territory, but clearly you can see that the bull markets last for an awful lot longer. And, so volatility is part of investing. It's the price you pay for that return over time. Markets generally go up more. They do go up more than they go down, and for longer periods. And so it's important to remember that. And it is important to remember to keep a cool head, particularly when you have these pockets of volatility. So from our perspective, it's always looking at, okay, look, what's the opportunity? Where are those opportunities arising? And everybody's focused on the US. And because it's such a big market, but what they're not really focusing on is the fact that European equities are doing quite well. UK equities are doing quite well. Gold, some alternatives are performing quite well. So hopefully, that's given you, a little bit of insight into kind of what's happening in markets today. And just before I go on to questions, I'm just going to give just a quick reminder of what we do. So fundamentally, on the offshore side, we've got a suite of funds. There's 4 funds there. And it's really quite simple. It's A, B, C, D, adventurous, balanced, cautious, defensive. And ultimately, that's just ensuring you've got something for all of your clients because they'll all have different appetites for risk. But we do try to keep it simple. So it's basic, it's equities, it's bonds, and you've got some cash in there. And from an alternative perspective, it's things like gold, nothing too complex. And one of the things we are really passionate about for clients is performance. And anybody who's heard me talk about process will know that it's quite detailed, etc., because we know that process delivers performance, and that's key for clients and something we're passionate about. Hopefully, you found that session insightful, and yeah, it's just happy to take any questions you might have on any of that.
Great, thank you very much, Nathan. That was really interesting, as I knew it would be, and as I said at the start, I think from a personal perspective, I think it actually provided some reassurance that things will be okay. Obviously, when markets are tanking, that's a concern for everybody. And as you said, there's almost an element of theatre to this. He wants everybody to come to the negotiating table. Let's not forget this is a guy that hosted a reality TV show, didn't he, in The Apprentice? So I think that sort of comes into play. I think from a personal perspective, there was a bit of nostalgia there in terms of my A-level economics days when you're talking about the wealth of nations and comparative advantage, and perhaps how that's free trade is obviously a good thing generally is the consensus, but it's been distorted perhaps by China. Which does lead me to one of the questions. So, if I understood correctly, you said that that obviously he's reversed on these tariffs and paused things, but China have still been very much sort of left out on a limb with it. Do you think this potentially does signal a decoupling for China and the US?
Yes, I think it's been happening. So what we've had is that markets have over time tended to perform in a quite similar way. And now, particularly this year, is a really good example of where the US is underperforming and China is doing something quite different. So I do think China's response will be slightly different to this because clearly they have a long-term mandate. And so if they're trying to implement their strategy, they don't have 4 years; they've got 40 years to implement it. So it's quite a long time, really. And what that means is that they'll likely to take a different approach. So if tariffs stick at high levels on China, they're likely to stimulate their economy. So people might think that could be quite bad for China, but actually it could be quite good because what they want to do is they want to create an economy where they have consumption to a similar level as the US. So they will move towards that over time. And if they have that economy that where you have Chinese consumers consuming in the way that US consumers consume, then that really changes the dial. And that would be a totally different economy. And it really would be the #1 economy in the globe if you get to that point. So I do think that they're looking to structurally change the mindset of the populace in China and orientate them towards a consumption-led economy.
Okay, thank you. One of the questions we've had in from an anonymous attendee is, thanks, Nathan. Are there emerging themes or regions that we should be preparing clients to take advantage of as opportunities develop this year?
Yeah, so I think if I'm thinking more long term, I think India is really exciting as a region because I do think from a manufacturing perspective, they've got lots of capacity to grow. They've got a very young workforce. They've got an educated workforce. So I do think there's a long-term structural growth theme there. I think for this year, I think fixed income looks quite attractive because a lot of people are concerned about debt in the US, and bond markets have sold off quite a bit. So we've been seeing this as a great opportunity to add to government bonds. So we've got long duration bonds in the UK. We've added long duration in the bonds in the US quite recently because we just think the market's overdone that piece. And we fundamentally believe that you're going to get more interest rate cuts in the US. We've had gold in the portfolio as well, which is a position we like. And clearly it's run quite hot recently. So we've actually been trimming that. And infrastructure is an area we like as well. So we do think there's a good theme there as well. As interest rates come down, infrastructure will tend to benefit from the fact that the financing of these projects, which tend to be, call it 10, 15 years. If you're building a port, it's such a long project. So your financing is so important, and the cost you get that at. If interest rates come down, it changes the dial on the profitability of that project. So that's quite exciting too in a lower rate environment. But the takeaway there is that actually there's a lot we're looking at. There's lots of areas that look quite interesting. So China could look really interesting as in Asia. That could be, something considering from an overweight perspective. The UK looks quite interesting. It's really cheap at the moment, and lots of energy companies in there too, and energy prices low. So as we come out the other side of this, you could see a real pop on that side. But yeah, there's lots of stuff we're looking at the moment.
Great, thank you. I think slightly touched on aspects of the answer to this already, but further question we've had is, when it comes to bonds, can you explain the so-called bond vigilantes and forecast long-term bonds in the near future?
Yeah, so bond vigilantes, almost, this kind of just talks about the fact that the bond market will keep spending in check from governments. So what happens is if you have too much debt, fundamentally, you should be offering people a higher level of interest for taking on the risk of buying your debt, because there's a higher probability that you don't pay back that debt. And so the US will be seen as this kind of safe haven country which is run well. And therefore, if people are buying their debt, they're usually they're getting a low level of interest in return from that. So your income payment, coupon payment is low because there's low risk of them defaulting. And what all of this does in the near term is it just makes people question that. So if you look at the volatility within bonds in the US, it's almost trading as if it's an emerging market, as if there's a higher potential for it to default or not pay back on that debt. So we do think that piece in the short term has moved too high. So the long end, basically, you've seen that on the short end and the long end, but fundamentally that's just talking about the yield curve, the different level of income payment that you get for different time periods. So if you buy a government bond for 2 years, this is at the short end. If you buy a government bond for 10 years, this is at the longer end. So what the US administration is looking to do is to tackle its debt so it can bring down long-term yields, because it's linked to their long-term ability to pay off their debt. And the short end tends to be more linked to interest rates here and now. So if interest rates come down, that can move down the short end. So we think actually both the whole curve comes down because interest rates will fall as inflation comes down and growth slows. And the long end should also fall as they get government spending in check. So that's what fundamentally they're trying to do, is just make I suppose the strategy that they have in place for growing more long term fundamentally. Yeah.
Great, thank you. So yeah, from a question about an entire asset class to one about an individual stock. You mentioned Tesla. What are your thoughts on them from a long-term investment perspective?
Yeah,
obviously, the shares have taken a hammering of late.
Yeah, I did a chart of the week on this fundamentally yesterday, or funnily enough, yesterday. And so I was talking about the drawdown for Tesla. And what you've seen is that Tesla is a very, very volatile stock. So you can have drawdowns of 50% easily, and it's happened multiple times. And clearly, they've always come back and bounced back. I think as an EV maker, so electric vehicles, the big challenge there is that they just have a lot more competition today. So all you have to do is walk out into your street and just look. It's not just Teslas. So I play five-a-side football every Tuesday night, and one of the dads has just got a new electric car, and he did have a Tesla, and he's changed it. So it just shows you that there's a lot more choice there. So that's the first thing. I do think that they're obviously, the battery technology is an area where they've made, I suppose, strives and innovation on that side, and they've generated a lot of revenue from that, battery storage, but there's more competition on that side too. And even if you look at battery charging as well. So in China, they've come out with a battery charger that can charge an electric vehicle in 5 minutes. So their superchargers quicker and faster than Tesla. So they're being competed on that front. So the big thing that they'll look to drive growth in the future is autonomous driving. I suppose that's likely to generate revenue, but you need almost the perfect city for that to work really well. It's harder on the backcountry roads here and in cities where it's not as structured as the US, where you've got that grid system. So people believe that actually, look, they'll generate some revenue from that, but it's not going to be the panacea, because there is competition from that too, with Waymo from Google, etc., who also have those electric cars. And then the last piece is around robotics. So it's building robots that can carry out, kind of manual chores, or in manufacturing facilities as well. So the view is that we'll all have a robot in our houses in 10 years' time, just doing the hoovering, etc. But there's competition on that side too. I think what's happened over the course of the last couple of weeks is really highlighted that China is not behind in the tech race. So whether this is DeepSeek on AI, or whether this is battery charging, or whether this is electric vehicles, they are ahead. So they can charge their cars faster. Their cars are faster. Their cars are cheaper. So this just breeds competition. So I do think Tesla is still an amazing company run by an amazing individual, and surely its share price will be higher over the long run. But I think that lead that they had over everybody else, that's now under question. But they're at the forefront of some great technologies, and so there is space for competition. It'll just make those companies better, and that has to be a good thing too.
Brilliant, thank you. Okay, final one then, which I think hopefully quite a good one to bring things to a close. As I say, you have touched on aspects of this already, I think, with the talking through what you think the logic behind Trump's strategy is. But how do you think it's best to frame the current risk environment to help clients stay focused on long-term goals rather than reacting to the noise?
Yeah, so I think fundamentally, as I mentioned, risk is it's part of investing, and return is the rewards you get for taking risk. I do think it is quite unsettling currently what we have happening in markets today, but it always remains really important just to stay grounded and to try and filter out a lot of the noise and understand actually what is happening. What is the objective of the Trump administration? And I would just counsel people to try and get a wider breadth of views. So opposed to listening to the stuff that you normally listen to, try and get the opposite side of that. Because if you're getting media from one side, you need to balance that out with the other side just to get a balanced view. Actually, is this right, or is it something in the middle? So we do subscribe to various different research outlets, but we listen to views from both sides because it just helps us to make better decisions. So all I would say is that for people to keep an open mind ultimately, and not be swayed too much by one side or the other.
Excellent. Right, Nathan, thank you very much indeed. I'll just bring things to a close with a few bits of admin from me. So firstly, a video of today's presentation will be hosted online, so that will be available shortly. Our Pulse newsletter, our latest Pulse newsletter will be going out next week. That will contain details of our next webinar, which is going to be with Rathbones. And finally, my colleague has dropped a link to our LinkedIn page in the webinar chat there. So please do follow us on LinkedIn if you haven't already for details of future webinars, future content that we will be hosting for you. So finally, thank you once again, Nathan. That was really interesting, as I say. And it's a pleasure to host that one. And thank you all, everybody, for joining us this morning. Thank you very much.
Thank you for having me.